Welcome to After the Bell, the capitalists versus consumers, Friday report. Today, we are combining our daily closing report and our full weekly breakdown into one episode because this week deserves it. It has been one of the most historic weeks in recent market history, and we are going to cover everything: today's close, the week's biggest stories, and what to watch in the weeks ahead. This video is for educational purposes only and not financial advice. Please hit the like button and subscribe so you never miss a report. Let's get into it. Today's close. Friday, May 8th, 2026. The market closed the week on a strong note. The S&P 500 gained 0.84% closing at 7,398, a new all-time high. The Nasdaq surged 1.71% closing at 26,247, crossing the 26,000 threshold for the first time ever and setting a new all-time high. The Dow Jones Industrial Average essentially finished flat, up just 12 points or 0.02% at 49,609, the odd one out in an otherwise strong session driven almost entirely by technology. The Russell 2000 Small Cap Index gained 0.76% closing at 2,861. Technology was the undisputed leader today. The S&P 500 technology sector surged over 3.27%, and since April 27th, the sector is up nearly 35%. That is an extraordinary move in just 11 trading days. The AI earnings season proved that the infrastructure build-out is generating real returns, and the market priced that in aggressively. The jobs report, stronger than anyone expected. This morning, the Bureau of Labor Statistics released the April non-farm payrolls report, and the number was genuinely impressive. The United States added 115,000 jobs in April, well above the consensus estimate of 65,000. The unemployment rate held steady at 4.3%. This is the best jobs report relative to expectations in months, and it sent stocks higher at the open. Here is what it means. The economy is not in recession. Despite elevated oil prices, record low consumer sentiment, a war in the Middle East, and the highest mortgage rates since 2022, the labor market is still adding jobs at a healthy pace. Companies are not cutting workers. People are still employed. And employed people spend money, which supports corporate earnings, which supports stock prices. The one complexity in this strong jobs number is the Federal Reserve. A robust labor market reduces the urgency for the Fed to cut rates. If the economy is growing and adding jobs, the Fed has less reason to ease monetary policy. That means rates could stay higher for longer, which is a headwind for mortgages, car loans, and credit card debt. But here is the nuance. If the Iran deal materializes and negotiations are still active, oil prices could fall significantly. Lower oil means lower inflation, and lower inflation gives the Fed the cover it needs to cut rates even in a strong jobs environment. The Iran deal and the Fed rate path are now directly linked. The Iran situation, complicated but moving. The Iran deal story took a significant twist this week. After Wednesday's optimistic Axios report about a one-page memorandum of understanding, the US and Iran actually exchanged military blows on Thursday near the Strait of Hormuz, the first direct military exchange between the two countries since the conflict began. And yet, the ceasefire is still technically in effect. President Trump said today that despite the escalating hostilities, the US-Iran ceasefire is still in effect, but warned the US would knock them out a lot harder and a lot more violently if Tehran does not accept the peace deal. Iran is still assessing the 14-point US proposal. Talks are continuing through Pakistani mediators. Oil prices are around $94 to $95 per barrel, meaningfully below the $107 high from earlier this week. Here is the bottom line. A formal peace deal has not been reached, but the fact that oil has fallen more than $10 from its peak, even as military exchanges continue, tells you that the market believes a deal is more likely than not. When and if that deal is formally confirmed, the market will react powerfully to the upside. The week in review. The 5 stories that defined this historic week. This was one of the most consequential weeks for financial markets in recent memory. Here are the 5 stories every investor needs to understand. Story 1. The Magnificent 5 earnings season verdict. This week delivered the most important earnings reports of the year. Microsoft, Alphabet, Amazon, Meta, Apple, all reported within a 48-hour window. Here is the final scorecard. Alphabet was the clear winner. Google Cloud grew 63%. The cloud backlog nearly doubled, and the stock surged nearly 9% to an all-time high. Its market cap doubling to $4.4 trillion in a single year is one of the most remarkable corporate performances in market history. Amazon delivered strong results. AWS grew 28%, the fastest growth in 15 quarters. Net income nearly doubled. Stock up approximately 4%. Microsoft beat on everything. Azure grew 40%. AI revenue up 123% year over year. Stock fell 4% because it raised capital expenditure guidance to $190 billion for the year. Meta beat dramatically on revenue and earnings, but fell 9% because it raised spending to $125 to $145 billion, and user growth disappointed slightly. Apple closed out the week strong. Revenue beat, services revenue hit a record, gross margin hit an all-time high of 49.3%. New CEO Tim Cook cited extraordinary demand for the iPhone 17 lineup. Stock rose more than 3%. The market's overall verdict: AI spending is real, and the returns are showing up most clearly at Alphabet and Amazon. Companies that demonstrate AI is driving revenue get rewarded. Companies that raise spending without equivalent visible returns get sold. That is the new standard. Story 2. AMD and the semiconductor surge. Advanced Micro Devices delivered one of the most impressive single earnings performances of the year, surging 20% on Wednesday after beating estimates and issuing second quarter revenue guidance of $11.2 billion versus the $10.52 billion analyst estimate. CEO Lisa Su's comments were the real story. She said agentic AI systems that can autonomously take actions, is driving a surge in CPU demand that became dramatically clearer in the last 90 days. That is the strongest possible counter-argument to the OpenAI revenue miss concerns from earlier in the week. The VanEck Semiconductor ETF gained approximately 4% on the day. Micron, SanDisk, and Intel all participated. The AI chip demand story is very much alive. Story 3. Dow 50,000. On Thursday, the Dow Jones Industrial Average briefly crossed 50,000 for the first time in its history. It did not hold at the close, finishing at 49,609. But the moment happened, and it is worth acknowledging. The Dow first crossed 10,000 in 1999. It crossed 20,000 in January 2017. It hit 30,000 in November 2020. And it briefly touched 50,000 this week. For anyone who has been investing patiently in index funds for the past decade, this week's milestone is a tangible demonstration of what staying invested actually produces. Story 4. The consumer paradox. One of the most fascinating and important stories of this week was the disconnect between how Americans feel and how they are actually behaving. Consumer sentiment hit a new record low of 48.2. The worst reading in the survey's history. People feel terrible about the economy. And yet, Visa reported 17% revenue growth. Starbucks beat earnings. Amazon's revenue beat by $4 billion. Uber confirmed robust spending on rides and food delivery. Disney reported strong theme park performance. McDonald's beat estimates. Consumers are stressed. Consumers feel bad. And consumers are still spending. The K-shaped economy, where higher-income households are barely affected by high oil prices while lower-income households are cutting back significantly, is showing up clearly in the data. The New York Fed published research this week showing that households earning under $40,000 per year cut gasoline consumption by 7% during the March oil price spike, while higher-income households barely changed their behavior at all. This divergence matters for the economy and for policy. The Fed's rate decisions affect all Americans equally, but the pain of high oil and high rates is falling disproportionately on lower-income households who have the least financial cushion. Story 5. The week's winners and surprises. Beyond the mega-cap earnings, several individual stocks delivered extraordinary performances this week. Fortinet surged 15 to 19% on exceptional cybersecurity earnings, OT security billings up over 70%, and free cash flow exceeding $1 billion in one quarter. Caterpillar surged 10% on blowout earnings. a bellwether signal that the physical AI build-out is driving real demand for industrial equipment. Warby Parker soared 27% on blockbuster consumer results. Fluence Energy surged nearly 40% on strong energy storage earnings. Rocket Lab soared 24% after beating revenue estimates. Citigroup announced a $30 billion share buyback, one of the largest in bank history. On the negative side, Cloudflare tumbled 22% after issuing weak guidance and announcing it would cut 1/5 of its workforce. Mercado Libre fell 11.7% after missing earnings despite strong revenue. CoreWeave, the AI cloud company that went public recently, fell around 7% after issuing revenue guidance below analyst expectations. Michael Burry, the investor made famous by The Big Short, warned this week that the market's fixation on AI is beginning to resemble the final stages of the dot-com bubble. His exact words, "Stocks are not up or down because of jobs or consumer sentiment. They are going straight up because they have been going straight up." A warning worth noting even if you disagree with his overall thesis. The weekly numbers. Here is how the major indexes performed for the full week. The Nasdaq gained 4.5% for the week, its sixth consecutive winning week and the longest winning streak since 2024. The S&P 500 gained 2.3%, also its sixth straight winning week. The Dow lagged significantly with a weekly gain of just 0.2%. The S&P 500 technology sector gained approximately 35% since April 27th, 11 trading days. That is an extraordinary move driven by AI earnings validation. The S&P 500 is up approximately 8% year to date. One Wall Street strategist appeared on CNBC today and said the S&P 500 could reach 10,000 to 13,000 in 3 years. Whether that proves accurate or not, it reflects the genuine optimism that strong earnings and the AI build-out are generating among professional investors. What to watch in the week ahead. NVIDIA reports earnings on May 20th after the close. This will be the single most important earnings report remaining in the season, and possibly the most important of the year. NVIDIA is the central node of the entire AI infrastructure build-out. Its results will either validate or challenge every AI-related stock in the market. The Iran deal remains the dominant wildcard. Oil around $94 to $95 per barrel is already providing significant inflation relief compared to the $107 peak. A formal deal confirmation could send oil toward $80 to $85. A massive positive for inflation, mortgage rates, consumer spending, and the Federal Reserve's rate path. Kevin Warsh's full Senate confirmation vote is expected in the coming weeks. His first policy decisions as Fed chair will be watched extremely closely, particularly in light of the jobs report today and the ongoing Iran oil situation. Earnings continue next week with dozens of S&P 500 companies still to report. Any commentary on AI spending, consumer behavior, or the impact of high oil prices will add important data points. The bottom line for everyday investors. This week delivered a remarkable amount of information, and the overall picture it paints is largely positive. Earnings are strong, significantly better than expected at the start of the season. The AI build-out is real and generating genuine revenue growth at the companies making the largest investments. The labor market is healthy with 115,000 jobs added in April, against expectations of 65,000. The market hit record highs despite oil above $90, a military conflict in the Middle East, record low consumer sentiment, and elevated mortgage rates. The risks are real and known. Iran remains unresolved. Inflation is still elevated. The Fed is not cutting rates yet. And Michael Burry's warning about AI resembling the dot-com bubble late stage deserves at least some consideration, particularly given that the S&P 500 technology sector has gained 35% in 11 trading days. But for long-term investors, the message this week reinforces what it always does. Companies are earning more money. The economy is creating jobs. And the long-term trend of the market is upward. Patient, consistent investors who stayed in through the Iran war fears and the OpenAI concerns are sitting on record-high portfolios today. Stay diversified. Stay consistent. Do not let any single week's headlines, positive or negative, change a long-term investment strategy that is working. That is your After the Bell. Friday report, and weekly breakdown for the week of May 4th through May 8th, 2026, here at Capitalists versus Consumers. Please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our daily after the bell report every trading day and our weekly breakdown every Friday after the close. We will see you Monday at the closing bell. Recommended reading for investors: The Psychology of Money by Morgan Housel, The Little Book of Common Sense, Investing by John Bogle, A Random Walk Down Wall Street by Burton Malkiel. This video contains affiliate links. I may earn a small commission at no extra cost to you.